Welcome back, everybody. We have a lot to talk about today as two of my portfolio companies have been in the news this week. Now, first off, Nvidia just reported earnings and once again beat expectations. But there was one thing they talked about that might indicate that a slowdown is coming. And Lululemon continues to dive into the red after I added it to my portfolio and just had a major executive resign. So in today's video, we'll go over Nvidia's earnings report and outlook for the future, as well as talk about what's going on with Lululemon and their stock price, as well as address the negative press that they've been getting. So let's go ahead and get started. Now, the biggest earnings report of the week was no doubt Nvidia's. And before we review what they reported, I just want to go back to a couple thoughts we talked about in previous Nvidia videos. So if the last year of history is any guide, Nvidia may end up with revenue around $26 billion or so. On some other basic level, I think they're likely to do a stock split probably soon as well, just because they're getting close to that kind of $900 or $1,000 mark, which, human nature, human psychology, how it works. Anytime these companies have a stock split, the stock tends to go up. But regardless of that, that's not why I bought it. And look, sometimes you get lucky and things play out kind of in the way that you expect. And yeah, it's pretty cool when that happens. But let's actually take a look at what they reported. Now, Nvidia reported revenue just above $26 billion, which was right where we predicted, and higher than Nvidia's own guidance of $24 billion and Wall Street's expectations of about $24.5 billion. They also reported non-GAAP earnings per share of $6.19 a share, up 19% from last quarter and 461% year over year. They also had gross margins at a whopping 78.9%, which was higher than their own guidance of a range between 76 and 77%. Nvidia had operating income of $18 billion, which was up 22% from just last quarter and an eye-popping 492% year over year. They also announced a 10-for-1 stock split, which we kind of expected at some point this year, and also a dividend raise of 150%, which sounds like a lot, but basically it's going from 16 cents a share currently to about 4 cents a share after the split. In terms of stock price, after hours, the stock was up about 6% at just over $1,000 a share. And as of Thursday morning, it's up over 9%. And now, obviously, it's still early in the day, so that could change. So all in, I thought Nvidia had a really great quarter. They beat expectations again in terms of revenue and earnings. The stock split, while it doesn't really change anything in terms of value in the stock, it's likely going to bring more investors into it, as we've seen basically throughout history, but most recently with stocks like Walmart. And when we look at what Nvidia gave for guidance going forward, they said they expect about $28 billion in revenue next quarter, with a gross margin between 74.8% and 75.5%, which to me was probably the only part of their announcement that had me a little bit concerned, because Nvidia's margins have been expanding every quarter since August of 2022, where it went from 46% to just under the 79% that it's at now, which is just a staggering expansion for a company of this size. So the question is whether or not the lower guidance for gross margin is a sign of margin compression starting and or their pricing power in the GPU market slowing down a bit. And if that's the case, it could explain the somewhat calmer reaction to the earnings report than previous quarters. But the cool part about this is that we can dig into the earnings call transcript and hear the company's perspective on it directly. And when talking about margins, they said that Q1 was similar to Q4 last quarter, where their margin benefited from favorable component costs, and that they expect it to be in the mid-70s for the rest of the year, similar to the comments that they made last quarter. And if we go back to last quarter's earnings call, we can see it right here, talking about their outlook for this current quarter. Similar to Q4, Q1 gross margins are benefiting from favorable component cost. Beyond Q1 for the remainder of the year, we expect gross margins to return to the mid-70s% range. So to me, this doesn't really look like something to worry about. Like, yes, it could be the start of Nvidia's margins compressing, but at this point, it's an expected outlook that they actually told us about 3 months ago. And there were other interesting things in the earnings report in terms of how they see the future, but I think I'm going to leave that for a different video some other time. But I did want to address a couple of the criticisms that I've been seeing online, because there's been a couple of takes floating around about how all of Nvidia's growth is coming from their data center segment, and that other segments aren't growing or aren't growing at the same pace. And honestly, I'm not really sure why this is even a criticism. I mean, clearly their data center segment is where most of their AI stuff is, and that's the part of the business that's growing like crazy. So I don't know that it matters if the other parts of their business aren't growing at the same rate. I just don't really look at it as a negative to have most of your growth coming from one segment, as long as you do the analysis on if that growth story is likely to continue and for how long, just like you would with any other company. So maybe I'm missing something there, but I don't really understand why that's even a concern or an issue. But overall, I'm very happy with Nvidia's performance, and I think that we're going to see it continue to go up as it gets closer to the actual stock split. And then, as Blackwell-related revenues hit later in the year, they seem poised to continue outperforming, at least in my opinion. But then, of course, that's why I bought them. Okay, let's go ahead and move on to Lululemon. Now, I added Lulu in April, and it's down about 17% since then, with it going down 7% in just a day on Wednesday this week, and down over 40% year to date. So what is actually going on? Well, the first piece of news is that Lulu's chief product officer, Sun Cho, was going to be leaving the company for a different opportunity. And for sure, anytime that your chief product officer kind of leaves unexpectedly, it's definitely not ideal, but Lulu stock's kind of been in this downtrend for quite a while since it was about $500 a share back in January, because it dropped to around $400 a share after their earnings in March, and then down to around $300 a share just this week. And if we try to understand why, it's a little bit confusing because their revenue guidance for this next quarter came in a little bit lower than analyst expectations, as well as overall revenue guidance for the year, but earnings per share guidance was still within the range of expectation. So yes, Lulu was maybe a little weak in terms of guidance, but it was probably more about a company that was trading at a 38 PE and a 25 price to cash flow coming down to a more reasonable valuation, which kind of makes sense with all the things going on in the economy and in the market, but it's actually continued to go down ever since. And really the only news that's come out has been what appears to be two analysts downgrading Lulu with not very much data behind it, at least with what's being shared publicly. With one being Barclays saying, "We believe teens and young women may shift their dollar spend away from categories in which they have significant product pre-existing in their closets," which was from Barclays analyst Adrian Yee. Adding that if a shift emerges in the second half of 2024, then we believe the decelerating trends we are seeing at Lulu may require more than a short-term fix with a quarter or season. With the macroeconomic environment in the U.S. still volatile and unpredictable, Yee worries that Lululemon might have difficulty sustaining new profit highs, especially as U.S. markets seem to be peaking on sales productivity. But then they say, "We do not consider this to be a brand health or brand desire issue, but one of reaching extraordinarily higher levels of productivity and profitability." So while they did downgrade Lulu and they see some potential headwinds there, it was more about what's going on in the economy than any issue with Lulu themselves. But the other was from Jefferies analyst Randall Koenig, who's been the subject of multiple articles about Lulu, as well as a CNBC segment.
Meantime, Lululemon losing its grip today. It's sliding to a more than 52-week low. The athleisure brand has dropped more than 37% year to date, and shares down another 2.5% after hours. This after the company said its chief product officer has resigned and will leave the company later this month. Our next guest says the company could crash as soon as next year. Let's bring in Jefferies' Randy Connick. Randy, great to have you with us. That doesn't sound good when the chief product officer quits. What do you make of that news?
Look, it's clear that the company's running into product problems, and it's clear that the company's running into competition issues. So this company, it's super simple. It has four issues. It has a category that's slowing. It has a competition that is rising. It has fashion shifts that are not going towards the company from a fashion perspective. We're moving from skinny bottoms to wide leg bottoms. And then finally, you have the law of large numbers. This is a $10 billion revenue company. And with competition from Alo and Biore, it's going to be hard for this company to keep growing.
So just to be clear here, we're talking about fashion trends changing from leggings to more wide leg bottoms, and that's this magical thing that's going to push Lulu down. I'm not really sure about this analysis. And honestly, some of the comments from Randall in other articles are kind of along the same lines, saying Jefferies analyst Randall Koenig took a first-hand look at Lululemon's merchandise offerings and was unimpressed with the color assortment, as well as the level of merchandise added to the sale rack and ample inventory of outerwear heading into the summer season. So again, these concerns seem wildly specific, like a perceived fashion trend transition from leggings to wide leg bottoms, and the fact that Randall didn't like the color assortment that he saw in the stores. These are just weird.
I mean, in terms of the fashion part of it, since the product officer resigned, I mean, okay, so wide leg bottoms, can't you just make wide leg pants? I mean, why is this that difficult? They're not locked into leggings forever. They do have wider leg pants at this point? Has Lulu just sort of lost its appeal?
Look, if you go back a decade ago, about 80% of the company's sales came from its legging product. So when you think of the word leggings, you think of Lululemon. And when the bottoms category is shifting to wide leg for the first time in a decade, this is a decade, it creates a massive headwind for the company if it's not known for that particular product category. So, when everybody wants the Lululemon legging, when leggings are in style, they're able to gain market share against competition. But when the actual fashion trend moves away from that to a wide leg product, the consumer doesn't necessarily have to go to Lulu, doesn't think of Lulu for that particular product, and they have the idea of potentially substituting for another brand, a potentially cheaper brand, to get that same look, if you will.
So this whole analysis is something that I just kind of question a bit, because even if 80% of their revenue was in leggings a decade ago, that doesn't mean that it's true today. As a matter of fact, in 2023 for the year, only 64% of their total revenue was actually women's clothing altogether, with 23% being actually men's, which obviously is not going to have anything to do with leggings. Plus, Lulu's growth trajectory relies heavily on international growth, where the athleisure trend is just ramping up. So even if you believe this wide leg bottoms trend is a big deal, which I personally don't, it's still going to be more regional in nature and not necessarily on a global scale.
It's Karen. Thanks for being on. So you talk about a number of micro problems and macro problems, and you're way below the street in terms of earnings. What is the biggest problem there? Is it athleisure has sort of run its course and now it's just going to be more difficult for them? Or do you think it's one of those other, is it aloe, is it worry, what is that puts you so far below the street?
Look, it's both. It's very simple. The street thinks that Lululemon's going to grow double digits into perpetuity. We think that Lululemon's U.S. business is going to turn negative next year for the first time ever. And why is that? Well, number one, the athleisure category used to grow at a mid to high single digit rate before COVID, grew to a double digit rate post-COVID. Now, after COVID, you have that COVID hangover, if you will. And that's creating a slowing in the growth rate for the backdrop of the industry. In addition, you have companies like, as I said earlier, Aloe and Viore. You're seeing it all over the place in terms of big cities. They're gaining market share, particularly Aloe, in a big, fast manner. So that's creating an additional headwind. And I think what the street is missing is they're not projecting U.S. sales to go negative next year. We are. That's why we're massively below the street. And when you look at our numbers, we're projecting overall growth for the company of 4% next year. That incorporates U.S. Turning negative, international still staying positive, but the street expects the U.S. business to stay positive and international growth to grow more than 40%. So the total growth rate for the company by the consensus is over 11% growth for 2025. We just think that doesn't happen.
Okay, so now we're getting to something a little bit more tangible. They basically believe Lulu's growth is going to severely slow down and the stock is going to be repriced based on their new slower growth rate. And look, that could definitely happen, right? I mean, this is part of analyzing stocks and buying individual stocks. We can all have different opinions and predictions for the future, but I think it's a mistake to assume that the pre-COVID growth rate is the one that we should be comparing to. Because I don't think the recent growth rates in athleisure is because of a COVID hangover. I think it's a larger trend towards more comfortable clothing, healthy lifestyle and living, which has become more popular overall, but especially with younger folks. And I don't think assuming a pre-COVID growth rate is going to return is the right thing, at least in my view.
Your price target is 240. The downside target is 150, which is quite different. So I'm wondering, in that sort of scenario, what is it a macro, the economy tanks, or is it going to be Lulu specific still?
It's an earnings go down and multiples compress. We've seen this in all types of companies. You know how it works. When the momentum leaves, so does the multiple, and earnings tend to go down with sales slowing, expenses deleverage, and margins compress. So, what we're saying is next year the company earns $12 in earnings. The street's saying 16. Slap a 20 on 12. That's $240. The market cap on that is still $30 billion. So it's not like we're expecting this company to shrink to an Under Armour type of market cap of $3 billion. We're still thinking it's $30 billion. That's the base case. But if the consumer in the United States continues to slow or slows further, if they start to go to the competitors, then you're looking at massive multiple compression, $150 stock price on the downside. Again, that's still a $20 billion market cap and still something that we can expect to see is a real, I think, relatively conservative assumption for Lululemon going forward.
So yeah, to me, this is an extremely bearish case on Lulu, and they mentioned trend data that they're looking at. I wish they would have shared some of that because it would have been maybe a little bit easier to understand why they view it this way, but they didn't, so it's really hard to know. Which means the best thing we can do is wait and see what Lulu reports in their next earnings report, which they just announced is going to be on June 5th, here coming up soon. But just one more thing, because I like to research and dig and try to understand kind of where people are coming from, there's one thing that I noticed that I wanted to share. Because Randall Koenig, who most of this negative press has been attributed to, has been saying this about Lulu for about 3 years. Here's him back in August 31st of 2023, August 30th of 2022, and even September of 2021. And look, I'm not saying that his analysis is wrong, but it's been kind of a 3-year story and just kind of continuing on. So, maybe he's right and maybe he's not. That's part of what makes stock investing interesting is we can have different opinions, and that's what creates opportunities. But this is another good example of why it's important to dig deeper than the headlines on some of these things, because then you find out that it's from one single analyst who's been saying the same thing about the company for 3 years straight. And look, I simply have a different view and still like Lulu as a company and think some of these concerns are really overdone. But I'm very curious to see what they report on June 5th so we can actually hear for ourselves how exactly their business is doing. So what do you guys think about Nvidia's earnings or the fact that Lulu's stock price just keeps dropping? Let me know down in the comments below. Now, if you want to see my initial analysis on Nvidia and when I added it to my portfolio, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.